Nvidia's biggest risk isn't China, and if you only watch the headlines, you will miss it while it is happening right in front of you. It happened quietly, and it should have been in the news because it tells you more about the next move in this stock than any export rumor ever will. In one recent quarter, Nvidia did about $57 billion of total revenue, and about $51 billion of that came from the data center segment alone. That is roughly $9 out of every 10 coming from one engine. And the same quarter, the company's gross margin sat around 73%, lower than the year before, while management talked openly about a shift in what they are selling, moving from just boards and systems into full-scale data center solutions. Now, here is the part nobody feels in their gut until it hits their portfolio. That same quarter, for customers, each represented more than 10% of Nvidia's revenue. The biggest was about 22%, then about 15%, then about 13%, then about 11%. If you add those four together, you are staring at more than 60% of revenue tied to 4 paychecks. You did that. You bought the story. You saved yourself from thinking about concentration because it feels boring. You paid for it anyway, because in markets, boring is where the risk hides. When a business is this concentrated, the biggest risk is rarely a single ban or a single political headline. The biggest risk is timing. The biggest risk is that the people writing the checks decide at the same time that they need to slow down for a quarter or two, not because AI is dead, but because the bill is so large they need to justify it. And that is what makes this dangerous. Because a slowdown does not have to be a crash. It can be a digestion phase. It can be a simple sentence on an earnings call that says, we are optimizing. It can be a budget committee that says, we want to see utilization. It can be a power utility that says the connection date moved. And the stock can still react like it saw a ghost because the valuation was pricing in acceleration, not digestion. So today I am going to show you the real risk, the measurable risk, the one you can track with numbers, and then I am going to hand you a scoreboard that tells you when the machine is still accelerating and when it is quietly losing momentum. And if you want more episodes like this where we take a story everyone argues about and we turn it into receipts and math, subscribe now and share this with one friend who thinks the only risk to Nvidia is China headlines, because that belief is how people get trapped buying the top of a great company. Now, let's address China quickly, like an adult, and then move on. China matters. Export controls matter. The company has already taken a hit that you can put a number on. There was a charge of about $4.5 billion tied to inventory and purchase obligations related to one of those restricted products, and sales of that product were about $4.6 billion in that same quarter before the change hit. That is real, but it is not the whole story. That is a punch you can measure, you can model it, you can say, okay, if that line goes to 0, what happens? Now compare that to the real swing factor. The real swing factor is that the buyers are now so large that their capex decisions are the climate in Nvidia's world. Microsoft recently reported capital expenditures of about $34.9 billion in a single quarter, and it said roughly half of that was short-lived assets, like GPUs and CPUs. Half of that means something like $17 billion in one quarter going into the kind of gear that drives this entire trade. Amazon has guided to about $125 billion of cash capex for a full year. Alphabet has guided to about 91 to 93 billion. Meta has guided to about 70 to 72 billion. Now do the simple comparison. Add those up and you are staring at something like $360 to $390 billion of annual spend from 4 players. That is not a market. That is a small group of wallets that can change direction and move trillions in market cap around the world. You did that. You saw Nvidia as a chip story. You saved time by not seeing it as a buyer concentration story. You paid because the market always punishes people who ignore who writes the checks. Now, here is the first uncomfortable truth. When spending is small, companies invest because it sounds good. When spending gets this large, companies invest only if it can be the moment your capex becomes big enough to show up in headlines, it becomes political inside your own company. And now it is political outside your company too. Data centers in the United States already consume more than 4% of electricity. And a widely discussed projection is that it could go to around 12% by 2028. If you're a household and your electricity bill is rising, you do not care what a GPU is. You care who is taking the power. So lawmakers start asking questions, regulators start looking, utilities start renegotiating, local communities start pushing back on new builds, and all of that turns a chip boom into a power and permitting bottleneck. That is the risk, not the chip, the bottleneck. Because when the bottleneck shifts, the spending shifts, and when the spending shifts, the winners and losers rotate. So if you own Nvidia, your job is not to guess the next headline. Your job is to track the bottleneck, because the bottleneck decides who has pricing power and who gets squeezed. Now, before I reveal the biggest risk in one sentence, you need to understand one thing, because without this, you will misread every earnings call in this space. Capex has two faces. One face is expansion. The other face is replacement and optimization. They both look like spending, but they produce opposite signals for the suppliers. Here is the simplest way to feel it. If you are building a house, buying bricks and hiring workers is expansion. If you are fixing leaks and rewiring, you are still spending, but you are not expanding the footprint. In the market, those two phases create completely different stock behavior. Expansion drives revenue surprise and multiple expansion. Optimization drives margin pressure, pricing negotiations, and multiple compression. So when you hear a company say we are spending, you do not clap automatically. You ask, spending on what and how fast does it turn into revenue? Now, watch what Microsoft told you with that one sentence. Roughly half of its quarterly capex went to short-lived assets like GPUs and CPUs. Short-lived means the cycle is fast. Fast cycle means faster pauses. Fast cycle means the buyer can stop ordering and still claim they are committed, because they are committed to the strategy, not to buying the same quantity every quarter. This is where the market gets emotional, because the market confuses strategy with timing. A company can be committed to AI for 10 years and still slow capex for 2 quarters. And that 2 quarters is enough to break a stock chart that was priced for perfection. You did that. You believed commitment means constant acceleration. You saved yourself from learning the cycle. You paid because cycles are where valuations live and die. Now let's zoom into NVDA numbers again, because the numbers are telling you the story earlier than the headlines do. Total quarterly revenue about 57 billion, data center about 51 billion, gross margin about 73%. Now, 73% is still a monster margin, but in this business, direction matters. If margins are compressing while revenue is exploding, it usually means one of 3 things. Either the product mix is shifting, or costs are rising faster than price, or the company is using pricing and terms strategically to secure demand and ramp a new platform. That is why the margin line is a clue. And Nvidia is telling you, in plain language, that the mix is changing because they are moving into full-scale solutions. Think of it like this. Selling GPUs is like selling engines. Selling full-scale solutions is like selling the engine plus the chassis plus the wiring plus the whole factory line that builds the car. You can make more money per customer over time because you become the system. But in the transition, you take on more complexity, you take on more supply chain, you take on more installation timing, you take on more working capital. And that is where the risk hides. Because when you sell a system, revenue recognition and cash flows can be tied to delivery and acceptance. If the customer says the power connection date moved, you do not get to argue with physics. The revenue can slide, the cash can slide, and the market punishes sliding, even if the demand is still there. So now we are getting close to the real risk. But before we name it, you have to see what the buyers are doing to the ecosystem. When buyers are spending 360 to 390 billion a year, they do not just buy. They negotiate. They demand better terms. They demand supply guarantees. They push vendors against each other. They build their own alternatives. They tell you they will buy your product, but only if you give them the economics. This is where the biggest risk lives. Not China. The customer, because the customer is no longer a customer. The customer is a power center. Look at it this way. If 4 customers represent more than 60% of revenue, you do not get to pretend you set the rules alone. You are negotiating with a small council of buyers who have the balance sheets to build their own silicon, their own networks, their own racks, their own data centers, and their own procurement strategy. That is why you are hearing more and more about custom accelerators. Not because they will replace Nvidia tomorrow, but because they change leverage. A credible alternative is enough to pressure pricing. Now, that does not mean Nvidia is doomed. It means Nvidia is entering the phase where the fight shifts from scarcity to leverage. Scarcity is when you can sell everything you make at any price. Leverage is when the buyer says, prove it and show me the return. And that brings us to the heart of this episode. The biggest risk to Nvidia is not China. The biggest risk to Nvidia is that AI capex growth slows from extreme to merely high at the same time that the company is transitioning its product stack, at the same time that power becomes a bottleneck and the market realizes the curve is not a straight line. That is the risk. A timing risk layered on top of a transition risk layered on top of a bottleneck risk. And when those three stack, you get volatility. Not because the company is bad, because the expectations were fragile. You did that. You confused a great company with a perfect stock. You saved yourself from learning the difference. You paid because perfect stocks break when reality stays great but becomes less perfect. Now, let's make it tangible with simple scenario math. If Nvidia makes $57 billion in a quarter and one customer is about 22%, that is about $12.5 billion tied to one buyer. If that buyer slows purchases by just 10% for a quarter because they are optimizing, that is over $1 billion of revenue swing right there. Not a recession, not a ban, not a collapse. A budget committee now stack that across 2 or 3 big buyers at the same time. The company can still grow year over year and the stock can still sell off because the delta is what markets trade. Markets do not trade absolute greatness. They trade changes in expectations. So now you understand why this is controversial. Half the internet screams AI is just beginning. Half the internet screams AI is a bubble. Both can be wrong in the way that matters, because the correct answer is usually this: AI is real and the spending is cyclical. Real and cyclical. So your job is not to pick a religion. Your job is to track the cycle. Now here is where you get paid for being early, because if the bottleneck shifts to power and cooling, certain companies start acting like early warning lights. Verdavi, Schneider Electric e AB. Gerência de enfermagem Vernova. Quantas serviços? When power delivery becomes the constraint, these names can keep climbing even if the chip leaders paused. Because the build out is still happening, it's just happening in a different layer of the stack. And on the network side, when clusters grow, networking becomes a tax on performance, Arista, Broadcom, and Marvel. When you see networking demand staying strong, it often means clusters are still being built out, even if GPU ordering cadence wobbles. And in the tool chain, when wafer demand is hot, you see it through TSMC and then through the tool names ASML, Applied Materials, Lam Research, KLA. The important part is not the ticker. It is the sequence. The sequence tells you where the bottleneck is moving. You did that. You treated all AI stocks like they move together. You saved time by not learning the stack. You paid because the stack rotates. And rotation is where opportunities and drawdowns come from. Now, let's talk about the other hidden force that can change the timeline without changing the story. Politics. When data centers start consuming 4% of national electricity and people talk about 12% in just a few years, the conversation stops being tech. It becomes a kitchen table conversation. Who pays? Who benefits? Who gets the jobs? Who gets the tax base? Who gets the noise and water usage? This is already happening. And once politics is in the room, timing becomes less predictable. Permits can slow. Interconnection queues can extend. Power contracts can get renegotiated. Suddenly, the same demand for GPUs exists, but the delivery schedule changes because you cannot install what you cannot power. That is why the biggest risk is timing. And now I am going to do something that will save you from 90% of the noise you see online. I am going to give you 3 simple dials that you can track every quarter, and they will tell you whether the AI build-out is still accelerating, whether it is digesting or whether it is rolling over. But before I give you those dials, I want you to lock in one idea that will stop you from getting emotionally manipulated by either side of the argument. A great company can still be a bad trade if you buy it at the wrong expectation. And a great trade can still be a bad investment if you ignore the cycle. So if you are up big, you protect part of it. If you are not in yet, you do not chase a straight line up and tell yourself you are late to a forever party. You wait for the cycle to give you a price that makes sense. And if you want me to keep updating the scoreboard every quarter, like this video, subscribe, and share it with a friend who owns NVDA and thinks the only thing that matters is whether China can buy chips. In a moment, I am going to hand you the 3 dials, and then we will run them through real numbers using the capex guidance from Microsoft, Amazon, Alphabet, and Meta. So you can see exactly how a slowdown from extreme to high can still change earnings momentum, margins, and stock performance across semis, networking, servers, and the power layer. First dial, capex velocity and capex composition, because the size of the check matters, but the type of check tells you the mood. When Microsoft spends about $34.9 billion in a single quarter, that sounds like a green light, but when it also says roughly half of that went to short-lived assets like GPUs and CPUs, that tells you something else. Short-lived assets are the easiest to pause. They are the easiest to renegotiate. They are the easiest to stretch out by 1 quarter without admitting you stretched anything out. So the first thing you track is not only whether capex is going up or down, but whether the language shifts from build to optimize, from capacity to utilization, from supply constraints to efficiency, and you run the numbers the way a CFO runs them. Amazon guiding around $125 billion of cash capex in a year means about $10 billion a month on average. If the board says we want a 10% trim for 1 quarter while we measure, that is about $3 billion of spending that does not disappear. It just moves in time. Alphabet guiding around 91 to 93 billion means roughly $7.5 billion a month. A small trim in timing becomes billions. Meta guiding around 70 to 72 billion means roughly $6 billion a month. Again, a small trim becomes billions. Now, you add the logic that actually moves markets. Nvidia does not need those customers to cancel the strategy. Nvidia only needs them to move the schedule. That is why this is a timing risk, not a faith risk. You did that. You thought the future arrives in a straight line. You saved yourself from looking at budgets. You paid because budgets move in chunks, and chunks move stock prices. Here is the simple stress test that makes the whole story click. If more than 60% of NVIDIA's revenue is tied to 4 customers, then a 10% pause by those 4 customers. At the same time, is not a 10% hit to NVIDIA. It is a 6% hit because 60% times 10% is 6%. Now put it into dollars. If the company does about $57 billion in a quarter, 6% is about $3.5 billion of quarterly revenue that can slide without any collapse in demand. Just a slide in timing. And here's why your chart can look ugly even if the business is still winning. Because markets do not wait for confirmation. Markets front run deltas. A $3.5 billion delta in a single quarter is enough for analysts to cut next quarter numbers. Enough for a valuation multiple to compress, and enough for social media to panic and call it a top. You did that. You bought the breakout. You saved yourself from asking what would happen if it merely slowed. You paid because the market punishes the word merely. Now the second dial, working capital stress, because it is the hidden thermometer of bargaining power. When a seller has all the power, they get paid fast. Inventory is tight, and customers beg. When buyers gain power, they stretch payment terms, they ask for bundles, they demand better pricing, and inventory grows because you are staging product for delivery schedules you do not fully control. That is why you watch inventories and receivables like a hawk. If inventories grow faster than revenue, you ask why. If receivables grow and concentration stays high, you ask who is negotiating. Because when the same few buyers dominate your revenue and your receivables, they dominate your future. Now do the quick margin math, because this is where the pain shows up before the headlines. If a company does about $57 billion in revenue and gross margin is about 73%, then gross profit is about $41.5 billion. If gross margin slips by just 3 points, from 73 to 70, that is not a small cosmetic move. 3% of $57 billion is about $1.75 billion of gross profit in 1 quarter. That is why gross margin direction matters, even when the margin is still enormous. Because when you are operating at scale, a small percentage is a giant pile of money. You did that. You saw a gross margin above 70 and assumed nothing can go wrong. You saved yourself from reading the direction. You paid because direction is what the market trades. Now the third dial, the bottleneck dial, power and permitting, because it is the piece that can slow the entire machine while everyone argues about chips. Data centers already consume more than 4% of United States electricity. And the scary part is not the number today. The scary part is the slope. When people talk about it going to something like 12% within a few years, that moves the argument from tech Twitter to city councils. It turns into who gets the power, who pays for the transformers, who upgrades the grid, who gets the jobs, who gets the noise, who gets the water usage. And once that happens, timelines get political, permits get slower, interconnection queues get longer, utility contracts get renegotiated, and a 1/4 delay becomes a chain reaction. You did that. You treated AI like software. You saved yourself from thinking about physics. You paid because physics is the ultimate regulator. Now, you have the three dials: capex, composition, and velocity. Working capital and concentration. Power and permitting. Here is what makes them powerful. They all move before the earnings headline. They all move while everyone is still cheering. They all move while the chart still looks fine. And now we are going to run the scoreboard through the ecosystem, because this is where you stop thinking like a fan and you start thinking like money. Start with semis. Nvidia is the king of performance, and it is still executing, but its near-term risk is pacing and expectations. AMD is the obvious challenger exposure, and it can benefit from share capture. But it also lives under the same buyer weather system, because if the buyer's slow, everyone feels it. Intel is trying to rebuild relevance with foundry and accelerators, but the market will demand execution, not press releases. Now, foundry TSMC is the heartbeat of high-end silicon. If wafer demand stays strong, TSMC stays strong. If wafer demand pauses, it is not subtle. It leaks through lead times, utilization, and order cadence. Now tools, ASML, Applied Materials, Lam Research, these names can feel a pause earlier than the front-end revenue numbers because tool orders are the long shadow of future builds. Now networking, this is where most people underestimate the stack. Clusters are hungry. They do not just need compute. They need to move data at speed. And that means networking becomes a tax on scaling. Arista is a beneficiary of data center switching demand. Broadcom has exposure through networking silicon and a wider enterprise footprint. Marvell has data center connectivity exposure. If the build-out is still happening but the mix shifts, networking can stay strong even if GPU ordering becomes lumpy. Now servers, this is where timing becomes visible. Supermicro, Dell HPI, these names can pop when orders flow and get punched when schedules move because they sit closer to deployment. If the bottleneck is power, server racks can sit in limbo, and limbo is where margins go to die. Now power and cooling, this is where the story gets spicy, because it flips the narrative from chips to infrastructure. Vertiv is exposed to data center cooling and power equipment. Eaton is exposed to electrical distribution. Schneider Electric and ABC sit in the grid and electrification plumbing. Quanta Services sits in the build-out and grid work. Javer Nova sits in parts of the power generation and grid equipment ecosystem. When power is the bottleneck, these names can benefit even if chip momentum pauses, because the build-out is not dead, it is blocked. That is a totally different market behavior, and you can see it in price action. In a digestion phase, the market often rotates from the obvious winner into the bottleneck solvers. You did that. You chased the most obvious ticker because it felt safe. You saved yourself from building a basket. You paid because rotations punish single name worship. Now, let's bring it back to the viewer ledger, because this is not just about stocks. It is about your life and your timing. You used AI tools. You saved hours. You saved attention. You saved money on tasks you used to outsource. But you also paid a hidden bill because the companies training and serving these models are paying for compute whether you click a button or not. They pay for clusters, they pay for networking, they pay for power, and they pay it up front. So the real question is not whether AI is useful. The real question is how fast that usefulness turns into cash flow that justifies the bill. Because in markets, cash flow is gravity. So now we run the 3-scenario model. Scenario 1, acceleration continues. Capex guidance stays aggressive. Language stays about supply constraints and expansion. Power deals get signed fast. Interconnection timelines stay manageable. In that scenario, Nvidia can keep surprising. Margins can stabilize after the platform transition, and the stock can remain a leadership name. Scenario 2, digestion. Capex stays high, but growth slows. Language shifts to utilization and efficiency. Buyers talk about optimizing spend. Power delays show up in some regions. In that scenario, the business is still strong, but the stock can chop because the multiple compresses even while revenue grows. In that scenario, you often see rotation into power and cooling names and into networking, while the pure chip leaders consolidate. Scenario 3, pause. Not collapse. Pause. A couple of major buyers trim short-lived capex for a couple of quarters. Maybe not because they want to, because they have to, because ROI scrutiny increases, because political pressure rises on the grid, because interconnection queues delay installs. In that scenario, the revenue can still be huge year over year, but the delta can disappoint and the stock can drop hard because the market stops paying for perfection. Now, here's the part that makes you money, because it tells you what to do before the crowd does. You stop asking, is AI real? You start asking, what phase are we in? And you do not guess it with vibes. You read it off the scoreboard, capex composition, working capital, power, and permitting. That is it. Now, I want to do one more piece of math that makes the whole fear narrative lose its power over you. If a buyer spends $380 billion a year across a small group, and they slow that by just 5% for 1 year, that is about $19 billion of spending that shifts. That does not mean it disappears. It means it moves. But in markets, moving is enough because suppliers planned inventory, manufacturing, and hiring based on timing. So a 19 billion timing shift can ripple into semis, networking, servers, and construction. That is why the risk is timing, not belief, not strategy. Timing. You did that. You assumed spending only goes up. You saved yourself from learning that cycles exist inside revolutions. You paid because revolutions still have quarters. Now, here's what other people do in this moment and why they get trapped. They either marry the story and refuse to trim, or they panic and sell the bottom of a digestion phase. Both are expensive. The smarter move is simple. You size positions so you can survive volatility. You avoid leverage that forces you to sell. You take partial profits when you are up huge, because you do not need to be right on every percent to win. And you diversify across the stack. So one bottleneck does not wreck your whole exposure if you want AI exposure, but you do not want single name concentration. You look at baskets like broad semiconductor ETFs and compare them to the pure single name bet. If you want a more defensive posture inside the same theme, you keep an eye on the power and cooling names because they can behave differently when the bottleneck shifts. And if you are the kind of person who needs sleep, you keep a larger cash buffer than the internet tells you is cool, because the fastest way to lose money is to be forced to sell. You did that. You treated investing like entertainment. You saved dopamine. You paid with stress and bad timing. Now, let's land the controversial truth clearly, so nobody can misunderstand what I'm saying. Nvidia can be a generational company and still deliver a brutal drawdown in a digestion phase, because valuation is a story about timing. That is why the biggest risk is not China. China is a headline you can model. The bigger risk is that the buyers decide at the same time that they want to see proof before they accelerate again. And when buyers dominate your quarter, you do not get to pretend you are immune to their mood. So here is your scoreboard in plain language, the one you can screenshot and use every quarter. When you hear Microsoft, Amazon, Alphabet, Meta talk about capex, you watch not only the number, but the words around the number. When you see Nvidia report, you watch not only revenue, but gross margin direction, inventory direction, and receivables concentration. When you see the grid conversation heat up, you watch permitting interconnection news and political scrutiny of who pays for power upgrades. And you remember one simple rule: if the bottleneck is chips, Nvidia leads. If the bottleneck shifts to power, infrastructure leads. If the bottleneck becomes ROI, everything becomes a negotiation. And negotiation is where margins and multiples get squeezed. If you've got value from this, like the video, subscribe, and share it with one friend who thinks the only risk to Nvidia is whether China can buy chips, because the real risk is already in the numbers, and the numbers do not care what the internet believes. This is for education and market understanding, not a recommendation to buy or sell any security.